Have you ever wondered what happens to a lie when it gets too big to hide? Have you ever considered the psychological breaking point of a financial system built entirely on the illusion of infinite supply? For decades, the silver market has been a playground for the world's most powerful institutions. We were told the price was set by the free market. We were told the massive short positions were simply hedging. But today, as we sit here in December 2025, the veil has not just been lifted, it has been shredded. We are witnessing the final, desperate acts of a cornered giant. Welcome to the era of the Great Betrayal. The whispers coming out of 60 Liberty Street, the headquarters of the Federal Reserve Bank of New York, and the inner sanctums of J.P. Morgan are no longer about managing the price. They are about survival. The latest data reveals a seismic shift that should haunt every person holding a paper contract and embolden every person holding physical metal. J.P. Morgan, the very entity that spent years sitting on a massive short position of over 200 million ounces, has flipped the script. According to internal reports and movements tracked by analysts echoing the deep-dive forensics of Zero Hedge, J.P. Morgan has quietly amassed a physical long position of 750 million ounces of silver. Think about that number. 750 million ounces. That is nearly an entire year of global mine production held by a single entity. Why would the world's largest bullion bank move from being the primary suppressor of silver to its largest hoarder? Because they know the COMEX is about to break. The fraud we are exposing today involves a mathematical impossibility. Current COMEX open interest is 250% higher than the total amount of registered silver available for delivery. In plain English, for every 1 ounce of silver sitting in a vault ready to be shipped, there are 2.5 people holding a legal contract demanding that same ounce. This isn't just a tight market. This is a mathematical default in progress, and it gets worse. While the world was watching the spot price fluctuate, the smart money was hitting the exits. This week alone, the SLV, the largest silver ETF, saw a decline of 38 tons of physical metal. Where did that silver go? It didn't go to retail investors. It was moved into private vaults to cover the massive holes in the institutional balance sheets. Right now, the most dangerous place to be is in a short position in Europe. Across the Atlantic, the London and European markets are facing a nightmare scenario. Open short positions on roughly 1 billion ounces of silver are currently underwater to the tune of $14 billion in unrealized losses. These are not just numbers on a screen. These are systemic threats to the solvency of regional banks. To understand the gravity of the situation, we must look at the geography of this crisis. It is not just happening in the COMEX vaults in New York. The silver market is a global nervous system, and right now that system is experiencing a total synaptic failure. For the last 18 months, a silent but massive migration of metal has been moving from west to east. While Western investors were distracted by the volatility of tech stocks and the drama of interest rate hikes, the Shanghai Gold Exchange became the real center of price discovery. Throughout 2024 and 2025, the Shanghai Premium became a permanent fixture. Silver in Shanghai was consistently trading at 10 to 15% higher than the price in London or New York. This created a massive arbitrage loop. Smart money and industrial giants were buying silver in the West at the suppressed COMEX price, taking physical delivery, and shipping it to the East to be sold at the real market price. This wasn't just a trade, it was a vacuum. It drained the LBMA vaults in London to their lowest levels in decades. It effectively hollowed out the Western silver reserves. And this is where the J.P. Morgan 750 million ounce long position becomes so critical. JPM isn't just investing in silver. They are the last bastion of physical liquidity in the Western world. They watched the Shanghai drain happen, and they realized that if they didn't pivot from short to long, they would be the ones left holding the bag when the delivery requests hit. They have positioned themselves to be the lender of last resort for the entire silver-consuming industry. This brings us to the most explosive development of the year, the Monday board vote. While there is no official public meeting on the calendar, the back channels are buzzing with news that the COMEX board is preparing for an emergency session this coming Monday. The agenda? A vote on the total suspension of physical silver deliveries. If this vote passes, the COMEX will essentially admit that it is no longer a physical market. It will settle all contracts in cash at a price they determine, effectively betraying the longs who actually expected to receive metal. They are calling this the Betrayal plan. The goal is to stop the price at $85 an ounce by forcing a cash settlement, preventing a run that would otherwise take the metal into the triple digits overnight. But there is a wild card they cannot control. Section 232. There are credible rumors that a group of industrial giants is lobbying for an adjustment to the Section 232 rules, a trade law usually reserved for national security threats. They want silver classified as a strategic critical mineral, essential for national defense and energy infrastructure. If silver is reclassified under Rule 232, the government could seize control of domestic supplies, effectively ending the COMEX's ability to trade the metal at all. Think of the COMEX like a high-stakes game of musical chairs. For years, there were 100 people playing, but only 10 chairs. As long as the music kept playing, as long as people were happy to trade paper contracts for cash profits, no one noticed the lack of chairs. But in late 2025, the music stopped. The industrial users, led by the massive demand for TOPCon solar cells and the 48-volt electrical architectures in new EVs, decided they didn't want the cash. They wanted the chairs. They wanted the metal. When 2.5 people are fighting over every single ounce of registered silver, the exchange has only two choices: default or change the rules. Default means the death of the COMEX. Changing the rules means the Betrayal plan. By voting to suspend deliveries on Monday, the board is essentially trying to turn the music back on by force. They are telling the long contract holders, those who represent 750 million ounces of demand, that their chairs no longer exist. They will be handed a check for $85 an ounce and told to go home. In Europe, the banking system is even more fragile. Many of the short positions there are held by commercial banks that were hedging for mining companies or industrial users. As the price ripped through $50 and then $60, these banks were hit with margin calls they couldn't meet. The $14 billion deficit is a ticking time bomb. If silver hits $85 and stays there, at least 3 mid-tier European banks face literal insolvency. Why is this happening now? Because the industrial vacuum has finally sucked the vaults dry. In 2024 and 2025, we saw a fundamental shift. This wasn't just about jewelry. The solar industry underwent a massive technological leap. The move from older P-type solar cells to TOPCon and HJT cells increased silver loading per cell by nearly 30%. In 2025, the solar industry alone is on track to consume over 250 million ounces of silver. Then look at the electric vehicle market. An average EV uses double the silver of an internal combustion engine vehicle. Between the wiring, the sensors, and the charging infrastructure, the automotive sector is now a primary competitor for the very same silver that the banks are trying to hoard. We are also seeing unusual facts emerge from the mining sector. Did you know that in 2025, for the first time in history, 3 of the world's largest silver-producing mines reported a 15% drop in ore grade? This means they are digging up more rock to get less metal. We aren't just running out of silver in the vaults. We are running out of silver in the ground that is economic to extract. The physical rush is no longer a theory. In India, imports of silver in the first half of 2025 have already surpassed the total for all of 2023. The Eastern world is draining the Western vaults at a record pace. They aren't buying paper. They are taking delivery of 1,000-ounce bars and moving them into private storage. This is the liquidity nightmare we warned you about. The 60% of stop losses set for December have already been triggered, creating a vacuum where there is no ask price, only a desperate bid. If the Monday vote goes through and deliveries are suspended, the paper price of silver might be frozen or manipulated down, but the physical price will detach completely. We are looking at a roadmap where $85 is merely a pit stop. If the Betrayal plan fails and the industrial users continue their panic buying, the supply chain will stay snapped. By 2026, the mathematical certainty of the deficit points to a price of $150 per ounce. This isn't an investment proposal. This is a structural reality. You cannot run a high-tech civilization on paper promises. You need the atoms. The banks like JP Morgan saw this coming. That is why they flipped from short to long. They are prepared to let the rest of the system burn as long as they hold the 750 million ounces of physical insurance. They have moved from being the market makers to being the market takers. When the COMEX finally breaks, whether it's this Monday or a month from now, the world will realize that there is silver, the metal, and then there is paper silver, the promise. The divorce between these two will be the most violent event in financial history. The stop losses we mentioned, the 60% of December contracts, are the fuel for this fire. Most of these stop losses were set by traders who never intended to take the metal. When they get triggered, it creates a forced buying frenzy that pushes the price higher, which triggers more stops. It is a gamma squeeze of epic proportions. The banks know this. JP Morgan knows this. They are sitting on their 750 million ounces watching the COMEX burn because they know that when the dust settles, they will be the only ones left with the physical inventory that Tesla, Samsung, and the U.S. Department of Defense desperately need. We are living through the Unobtainium phase. If you are holding physical silver right now, you are holding the only form of the metal that is immune to a COMEX board vote. You are holding the only form of the metal that cannot be cash settled. You are holding the only form of the metal that will participate in the run to $150. As we approach this Monday, the tension is palpable. The Betrayal plan is ready. The 232 adjustment is on the president's desk. The shorts are $14 billion in the hole, and the industrial giants are refusing to stop their buying. This is the end of Economics 101 and the beginning of a survival economy. I want to remind you, we are not here to give investment advice. We are here to report the data that is being suppressed. We are here to show you the cracks in the vault walls before the whole building comes down. The facts and dates we've discussed, from the 38-ton SLV decline to the 250% open interest gap, are the breadcrumbs leading to the truth. The great betrayal isn't coming. It's here. It's happening in the fine print of the contracts you think you own. If you want to be part of the community that sees through the fraud, that understands the mechanics of the physical rush, and that is prepared for the 2026 reality, you know what to do. This is a story that changes by the hour. We are monitoring the London Fix, the Shanghai premiums, and the COMEX warehouse reports every single day. What is your plan if the COMEX settles your silver position in cash on Monday? What is your plan if the real price of silver hits $100 while the screen price is frozen at $85? These are the questions we need to answer together. Subscribe to the channel so you don't miss our emergency update following the Monday board meeting. We will be the first to break the news of the vote results and what it means for the physical market. Leave a comment below. Tell us, are you seeing silver disappear from your local dealers? What are the premiums you're being quoted? The boots-on-the-ground reports from our viewers are often faster than the official data. Your comment could be the warning someone else needs to hear. Subscribe and leave a comment. Stay vigilant.